All right, we might just get underway. So thank you everyone for attending today's webinar. We've got a few people still joining. I'd like to thank everyone for attending this webinar today. It's being recorded, so I know a lot of people actually watch the recording afterwards. So we'll be recording this and sending out a copy of this presentation after the webinar. We'll be having a Q&A. So down the bottom of your screen, you'll see a panel. Click on the Q&A icon to ask questions. No one will be able to see your questions except for us on the panel. And at the end, we'll ask any questions that haven't sort of been covered off. I thought it's a very good time to introduce our guest for today. We've had record interest rate rises over the past 12 months, inflation at its highest in 40 years. Global stock markets have been falling, property price declines. New federal government, which announced their latest budget this week. So I'd like to introduce our guest today, David Bassanese from BetaShares. So David is the chief economist at BetaShares since 2014. He is responsible for developing the economic insights and portfolio construction strategies at BetaShares. So prior to BetaShares, David was a senior financial commentator with a Fin Review. He's previously worked at Macquarie, Federal Treasury, and the OECD. David has honours degree in economics from the University of Adelaide and a master's in public policy from Harvard University. David has featured many times on television, radio, various news outlets for his opinions. He also has a regular blog called Bassanese Bites. So if you're interested in that, you can sign up to that. So I'd like to welcome David. I'd like to thank you for your time today. And David, I will leave it in your capable hands.
Thanks very much, Lee, and great to be with you all today to share with you some of my thoughts on the markets at the moment. As Lee mentioned, a lot of things going on. There's always something going on in financial markets. So, but I would say, I think obviously over the past year or so, there's been more than the usual amount of things going on and to get our head around. But I'll give you the lie of the land as I'm seeing it at the moment. I mean, I still think there's a few tricky things that as investors we need to be conscious of and negotiate in the months ahead, which I'll get into. Just firstly, like a snapshot really of the economy, just some charts there. You can see the COVID collapse. We had 2 quarters of negative growth. In fact, a very small negative there. So with the shutdowns and whatnot in 2020, economy went through a downturn. We've bounced back pretty strongly. Growth has been pretty solid over the last couple of years. Is starting to moderate a little bit under the influence of the RBA raising interest rates. You can see the latest quarterly number there, 2.7% year-on-year growth. Unemployment low. We're at 50-year lows of the unemployment rate, down around 3.5%. But that strong bounce back in the economy, along with the bounce back in the global economy and the supply chain bottlenecks associated with COVID, has meant that inflation's spiked higher, quite a bit higher. Absolutely no one anticipated this would come as a result of COVID, but it sort of sprang upon us over 21 and has hung around in 22. And central banks have initially tried to hope it would be temporary. They concluded that it's hanging around a bit longer than we hoped. And the risk is that if they allow it to stay around at high levels, that it could feed into inflation expectations and wage and price setting behavior, and the psychology of inflation of the sort we saw in the 70s could return. And so as a result, central banks have been raising rates, trying to slow the economy, hopefully not cause a recession, but at least slow the economy to help encourage inflation to come down. Good news is that inflation in Australia looks as if it has peaked, and in the United States, as I'll touch on in a minute, has also peaked. It's coming down. The only question at the moment is, is it coming down fast enough before it can get embedded into inflation expectations, or is it going to come down and then level out at a still uncomfortably high level? So the inflation task ahead of us is certainly not over, but the pain of the interest rates that we've seen over the past year is at least acting to reduce that. The other obviously focus of many Australians is house prices. This is a chart of the median national house price according to CoreLogic. You can see that over the course of the past year, we've actually had about almost a 10% decline in national house prices. In areas like Sydney, it's been closer to 14, 15%. But the last couple of months, on the back of the talk of a pause by the RBA, back in April, they did, not raise rates, and there was talk that they may at least hold rates steady for a little while, and that's encouraged a bit of a bounce back in house prices of late. I think that's one of the reasons the RBA was probably concerned about house prices bouncing back too quickly, because it doesn't want consumer spending to slow, and if house prices are bouncing back strongly, that would challenge that view. So they did raise rates in May. As a consequence. And I think the other reason the RBA raised rates is the fear of inflation being sticky, particularly service sector inflation, because that's what we're seeing globally. But a snapshot, that is sort of the economy as of the moment. Good growth, inflation high, but hopefully coming down. House prices having corrected, but look as if they're bottoming out. I don't anticipate a huge rebound in house prices, but I think even if the RBA, doesn't cut rates anytime soon, they're probably at least going to be bottoming out here. These are some features on inflation. You can see there. I mean, look, the story of inflation is that it's broadly based. It's across both goods and services. This is just a breakdown of the various components. New dwelling prices. We've had we had the encouragement of home building during COVID, coupled with supply, labour and material shortages, saw the price of new homes go up. But we've seen other things like fuel prices, consumer durables, utilities, a whole bunch of things basically going up. And you can see there by the percent of items that are right, the annual rate of CPI items that are running at above a 3% pace of inflation, you can see is relatively high. Now, so far, but as I said, look, we have seen signs of a moderation. So goods inflation. So if you think about inflation, there's two key elements. There's goods, physical goods, things like furniture, clothing, petrol, these sort of issues, they are rolling over, and supply chain bottlenecks globally are easing. But service sector inflation, things like airfares, hotels, cafes, these things are remaining sticky at the moment, and that's partly because of the rebound in growth, of the increase in demand for services, the pent-up demand for services coming out of the lockdowns. But there are signs of an easing. So the RBA has responded to that by raising interest rates, with a desire to slow the economy, not push it into recession, but to have a period of what we call below trend growth, so that the unemployment rate can go up a little bit. So, and in fact, their forecasts are of the unemployment rate to rise to about 4.5% by the end of next year, and that should keep a lid on wages growth and help to moderate some of the pricing pressure we're seeing in the retailing sector. Now, so RBA is going to keep raising rates if inflation stays high and growth doesn't moderate. But the good news is that we are seeing some signs of moderation. So if you look at things like job vacancies, very high still, but coming off. So that's the orange line there is ANZ job ads. The vacancies there is a survey by the statistician, the Bureau of Stats. You can see labour demand in Australia is still very strong, but at least some signs of moderation. The other thing happening in the labour market, of course, is that immigration is coming back, storming back, I guess you would say. So during COVID, with the lockdowns, we had very little immigration, very little tourism. I'm sure here in Brisbane, the backpacker market, how they're very important to the hospitality sector. We lost a lot of those workers, but they are now storming back. You can see that over the course of 22, immigration has returned. And now that cuts both two ways. A, it will stimulate demand. There'll be more people out there shopping, but it also helps to ease labour supply bottlenecks. and so potentially keep a lid on wages growth. So in terms of monetary policy, at least, I guess that sort of mixed. It contributes to demand, but it also contributes to supply. But on balance, I think it's probably more likely to keep a lid on interest rates because it will reduce the risk of a wages, bottlenecks causing a wages breakout. So that's the labour market.
Just a quick question.
Sure.
Just a quick question on the immigration. I think I can't remember the exact numbers, like 300,000 or 400,000 people expected to immigrate into Australia. Well, what's that going to have on, I guess, rents and property prices, do you think?
Well, it'll put a lid on it'll put a lid under property prices. So I mean, even today, like we do have, rental markets around Australia are pretty tight. What we've seen is that the increase in interest rates has meant that would-be first home buyers being priced out of the market. They've had to stay in the rental market. So in turn, that's tightened up the rental market. It's not going to be helpful for it. But I don't expect. But going the other way, I mean, the overall economy is slowing. We do anticipate the unemployment rate rising by 1%, and also mortgage affordability is at very poor levels. In fact, I've done some numbers that the percent of income that an average household needs to devote to pay off a mortgage on a medium-priced home in Australia today is at the highest level since 1990, back when we had mortgage rates at 16%. So that suggests that you're not going to get a lot of explosive house price growth because basically the average household can't afford to pay any more than what there is at the moment. But you're right. I mean, it's going to add to the tightness of the housing market, particularly the rental market. So it's just it's interesting. The government, they have thrown. We're not going to get immigration of 400,000 a year. What we're seeing at the moment, though, is a bit of pent up, catching up from the backlog of the low of the year to a couple of years in which we had very little immigration. The long run likely. The long run historic amount has been around 200 to 220,000. So we're going to get a couple of years of well above that, and then it should moderate back down toward 200,000. But still, it's still quite significant, no question. Just other signs of weakness in the economy. So this is a chart of building approvals. You can see that this is the spike, the COVID spike. So the government, to encourage activity, did offer subsidies for home building, and so we had a strong lift in approvals for new homes. That has now fallen on the back of rising interest rates, and so the building activity at the moment is still at a high level because there's a backlog of work that builders are still working through, but that should start to moderate over the course of the coming year. But perhaps most importantly for the economy, though, has been consumer spending. So consumer spending is about 60% of GDP. And so if you want to slow the economy, you've got to slow consumer spending. And we are starting to see signs of that. So this is the quarterly growth in real household consumer spending. You can see in June last year, it was at 2%. Eased to about 1% in September, and then it eased to about 0.3% in the December quarter. And the estimates for the March quarter just ended is for another pretty subdued number. That's a forecast from the RBA. So consumer spending, which has been strong for a long time coming out of the COVID lockdowns, a period of low interest rates, a lot of fiscal stimulus, is finally starting to moderate. And that, again, another reason why the RBA is probably close to finished in terms of raising interest rates, at least. The other thing, the important difference between Australia and the rest of the, particularly the United States, is that this is a chart comparing different features of the US and Australia. So you can see the US has a similar unemployment rate to us, very low, around about 3.5%. Participation, in fact, in other respects, it's similar. We have high inflation, high core inflation, labour force participation. There was a period there where labour force participation in the US was lagging, but it is sort of almost back to pre-COVID levels. So that's not much of a difference. But you can see here, one big difference is that wages growth in the US is running at over 5%. So their labour market, 3.5% unemployment, is causing wages growth at rates inconsistent with getting inflation back down to their target levels of around about 2%. Whereas in Australia, it's still running at just over 3%. Now, it could change, it could rise by more, but at the moment, it's certainly at a level which is not threatening inflation over the longer run, which means that the RBA, as we've seen over the past year, has been able to give the economy a bit more benefit of the doubt, has not needed to raise interest rates as aggressive, or felt the need not to raise interest rates as aggressively as we've seen in the United States. And the RBA still thinks that provided wages don't, rise to 4.5%, 5%, that it can be patient in waiting for inflation to come down without having to drive the economy into recession. Whereas in the US, it's still the Fed. They're hoping that they don't need to cause a recession to get inflation down, but I think the Federal Reserve over there, the US central banks, their own staff forecasts are predicting a recession to kick in the second half of the year. And at the moment, if it takes a recession to get wages growth down, then so be it. But the Fed are basically more, I guess, more prepared to do that, or it looks as if it's going to be more required in the US given the wages story. But I'll touch a little bit. I am. There's not for reasons I'll get into, but there's not a lot of evidence apart from the yield curve at the moment. So the markets are pricing in very aggressive rate cuts in the US in the second half of the year, of an order that we've never seen without a recession. So the bond market is certainly thinking something nasty is happening, or the bond market is assuming that inflation in the US is going to drop like a stone over the next 6 months. Now, I think it's unlikely to drop like a stone. So either the bond market is wrong and bond yields are going to, sell off, or you will get a downturn. But it comes back down to this wages story. Like if wages in the US can fall without the unemployment rate going up, happy days, they don't need a recession. But if wage inflation remains sticky, then one way or the other, that unemployment rate will need to rise. And historically, every time it's increased by about 0.5% in the US, it's tipped the economy into recession. So that's the so-called, it doesn't take much, but once you get enough negative forces to push that unemployment rate up, it really only goes up by 0.5%. It usually there's enough negative momentum that builds up in the economy that the unemployment rate goes a lot higher. So
until they do break something.
Well, so what we're seeing at the moment in the US is they've got a banking, the small and medium-sized banks in the US are actually under pressure now because for a long time they never paid any interest on their deposits. Now households and businesses are realizing, we don't need to keep our money in banks and get no money. We can put them in money market funds. We can invest in treasury securities, and we can do it with a couple of press a few buttons on our mobile phone. So deposits are a lot more mobile, and so they are basically now under pressure to either increase their deposit rates to retain their deposits, which in turn means they need to increase their lending rates, or suffer deposit outflows and have to cut back on their lending. So there is a bit of which you can say, well, what's the big deal? It's all a part of the monetary transmission mechanism. But some banks have fallen by the wayside over the last few weeks. I'm sure if you read the financial press, you'll see. And so there is a credit tightening going on in the US at the moment. So it's either that causes. So really, if you need a recession, because if wages don't fall, you need a recession. And then the question is, well, what will cause that recession? If the credit tightening that's going on through the banking sector does it, then the Fed doesn't need to do a lot more work. So bond yields are fine, they won't go up anymore. If the credit tightening doesn't cause that slowdown, then the Fed needs to do more work. Now, so that's the sort of state of play at the moment. At the moment, the markets are saying the Fed is done. They're not going to raise rates any further. And in fact, they're going to cut rates in the second half of the year. Now, exactly why the market thinks that they're going to cut rates is a debate, open for debate. But the reality is the bond market is pricing in those rate cuts. But we're at a point in the market in the US where we're watching the wages numbers, we're watching the inflation numbers. We're seeing if they can come down, fast enough of their own accord. And we're also watching the credit tightening to see if that starts to slow the economy. And, depending on how those two things play out, will depend on what the Fed ends up having to do. But what I would say is at the moment, inflation in the US is easing, but the services side of inflation still looks sticky, and wages certainly, if you look at across a number of measures, still looks uncomfortably high. So at the moment, I think the Fed would conclude that they still need to see that unemployment rate go up, and that what's keeping the Fed on the sidelines at the moment is uncertainty about to what extent that will be achieved by the banking crisis or the credit tightening that's going on in the US.
So this is not another GFC kind of event with the banking crisis, in your opinion?
No, I don't think it's a system. Well, certainly it's not the big so-called systemically important banks. The JP Morgans, the Goldman Sachses. They are fine. In fact, they're getting all the deposit outflows from the smaller banks. It's probably more akin to the savings and loan crisis that the US had back in the 1980s, where there was a bit of a example of poor, which was another type of a crisis. But many small banks in the US, went broke over that period for reasons I won't go into at the moment. But basically, the interest rate, where they raised interest rates and exposed a lot of and it caused a bit of a property crunch, and a lot of banks were exposed to that property sector, and they fell over. So at the moment, at the moment the problem is that small and medium-sized banks have relied on deposits not leaving. They assume that they'll have sticky deposits, and now they're finding that those deposits are leaving, and they're having to adjust to that. So it's not really a crisis. I actually think it's more akin to just saying that the monetary transmission mechanism is working a bit more effectively than it would otherwise work, because the whole point of the Fed raising rates is to raise lending rates, is to slow credit growth. And so to the extent low yielding deposits not moving was meaning that lending rates didn't need to go up by that much, then it was blunting the transmission mechanism of monetary policy in the US. Now I just think it's speeding it up a little bit. But just to again reiterate, very important difference between Australia and the US is that at the moment unemployment rates are equally low, but wages growth in Australia not as threatening to the inflation outlook at the moment as it is in the US. So the US is under more pressure to slow the economy compared to us. So what does that mean for policy? This is a chart of what the market expects the RBA to do over the coming year. There's that markets are actually pricing in maybe a 20% chance that the RBA could raise rates again in June. But because the labour market is still solid, and they surprised everybody by raising rates in May. So look, it's still not expected, but there is a small probability being priced in, and thereafter interest rates basically flat for the rest of the year, and then they're pricing in some cuts through next year. But I think in the short run there is a tightening bias. If anything, over the next 3 months, the RBA is more likely to raise rates than cut rates. My base case is they won't raise rates; they'll remain on hold. But then as the US economy slows and our own economy slows, it's quite reasonable to expect the RBA to eventually cut interest rates either later this year or certainly in 2024. So from a first, I guess, implication of that for investment markets is that the bond market sell-off that we saw through most of last year is probably behind us. And so the yields on bonds, I think, are attractive. So I've got 10-year bond yields, you can see, sold off dramatically through last year as the RBA raised rates. But really, since about the middle of the year, so the latter half of last year, bonds have gone in a sideways range because the markets have not priced in further aggressive tightening beyond the sort of 4% level. It's close to what we are at the moment. So that's point one. Just go to the next slide. But as I said, so that's really the Australian situation. We're wanting the economy to slow. There are tentative signs that it is slowing. Provided that remains the case, the RBA can remain on hold, and as that slowdown, gathers momentum, they can cut interest rates. And given the benign level of wages still, the RBA doesn't need to drive the economy into recession. So it is counting on a soft landing for the economy. Now, in the US, the big risk for us is, of course, what's happening in other markets. And this is just a chart of the US situation, the unemployment rate and wages growth. You can see, as I said, I won't go over this again, but basically wages growth at the moment still relatively high in the US. And in fact, higher than we've seen at any time going back, 30, 40 years. These grey areas are recessions in the US. And so the challenge at the moment is that once wages growth breaks out, it's never fallen in a meaningful way without an increase in the unemployment rate. And once that unemployment rate goes up at least 0.5%, it usually goes up more and it causes a recession. So that's the reality. So to think that this grey line can fall all the way back down to here, sort of where we were prior to COVID, without this orange line going up, that's what you require for a soft landing. That's what you require to think that the equity markets are a great buy at the moment. But if you think this grey line can't fall without this red line going up, then you're facing a hard landing and potentially another leg down in the equity market. And just on that front, I mean, there are tentative signs of a soft landing. And so this is a chart of job vacancy rates in the US. So vacancies as a share of the total employment versus the unemployment rate. And so basically what we've seen is that the level of job vacancies have fallen. Usually there's a negative relationship. So when vacancy rates fall, unemployment increases. But at the moment, we've seen the vacancy rate fall from an incredibly high level, so incredible level of excess demand for workers, and it has fallen. And so far, at least, there's been no increase in the unemployment rate. It's actually it's still stayed around 3.5%. And the soft landing hope is that the excess demand for workers, if you like, can fall. So businesses give up trying to find workers that they can't find because the labour market's too tight. That in turn reduces wages pressures because businesses aren't scrambling to find workers, but they retain the workers they currently have, and the economy doesn't contract. And so that if these dots continue to move back down to here, these black dots here are the situation in 2019, where we did have a vacancy rate, still a very tight labour market, but vacancy rate sort of back to where we were in 2019. And if you look on the next slide, this is I just explained, this is the unemployment rate here. These are two measures of wages growth, median and average wages in the US. And you can see it is possible. So in 2019, you had an unemployment rate sub 4%, and we had wages growth running at 3.5%. At the moment, as I said, on both of those measures, it's certainly higher. But the hope is that these numbers can come down without this orange line needing to go up. And so that is the debate at the moment between the soft and the hard landing. I just think once they've accelerated to this extent, it's going to be hard for it to come back down again without this going up. But the soft landing argument, the camp are focusing on 2019 and saying, look, it is possible. So we'll see how that plays out. That is one of the big debates in financial markets at the moment. Just in terms of the share market, and the share market is vulnerable to a harder landing. And so this is a chart of the US share market. You can see the market had a sell-off through last year on the back of rising interest rates. So the PE ratio, so the price to earnings ratio of the market went from about 22 times earnings down to under 16 times earnings at the bottom of the market in October last year. But with that recovery in the market since late last year, the PE ratio has gone back up to 18. So all of that recovery in the market has been valuations, because earnings have actually been falling over this period. The market has bounced back. The market's bounced back for two reasons. Firstly, inflation in the US has peaked. It is coming down. And so there's hopes that, we'll keep coming down and we don't need a recession. And the economy has remained resilient to date. So despite all the rate rises in the US, employment growth is still positive. Retail sales are still strong. So as I've been arguing, the market will basically trade on the hope of a soft landing until the evidence proves otherwise. And so we're just waiting to see how that evidence plays out. But the market is certainly not pricing in a recession. It's pricing in the hopes of a soft landing, given the valuations. And at the moment, earnings growth is still positive. The market's expecting flat earnings for 23 on 22. These are analysts' expectations for earnings for each calendar year on a rolling monthly estimate. And you can see that the estimates of 23 have come down over the past year and for 24, but they're still expecting only flat earnings growth this year and then a 10% bounce back next year. And so that is vulnerable to a harder landing for the US economy. I think that's pretty, in terms of Australia, look, our market is not as expensive, but all I would say is our market has bounced back. It's been in a bit of a choppy sideways range though for the past year, and it's because earnings, you can see here, have been pretty flat. So we had a nice run up of earnings for a while, but the earnings in the mining and energy sectors in particular are expected to fall over the next couple of years, and that's constraining the overall earnings outlook for the market. But the main point for Australia is that if the US sneezes, we catch cold. So you can analyse the fundamentals of the Aussie market as much as you like, but if the US goes into recession and Wall Street has another leg down, we're going to get caught up in that. So that's why a lot of my focus is on really the US situation. Just conclude on the Aussie dollar. Again, if you think a soft landing in the US is coming, Aussie dollar will benefit greatly and could potentially push up over 70 cents. But if a hard landing in the US economy kicks in, then it will weaken. And so my base case, it will weaken toward the low 60 cent area and potentially in a bad recession, break under 60 cents. So all of these things are correlated. It's really, but as I said, asset allocation at the moment, investment decisions at the moment really boil down to one's view on soft versus hard landing of the US economy. Because if it's a soft landing, great for equities, also good for bonds, great for the Aussie dollar, great for resource companies, great for pretty much everything. If it's a hard landing, it'll be great for, even better for bonds, because the central banks will reverse course and start cutting interest rates. Not so good news for equity markets, not so good news for the Aussie dollar. And unfortunately, at the moment, my bias is still that we're probably going to need to see a harder landing in the US, given that the wages and labour market situation there. That's pretty much it for my I haven't talked about China. I mean, or Europe. China's bouncing back out of the COVID lockdowns, but growth, it's not going to save the economy if the US has a recession. China is going to grow, it's going to do okay, but it's not, its days of supercharged economic growth are behind it because its population is slowing. They've got a debt overhang from a property bubble. And so I think, positive, but nothing to get too excited about in terms of growth in China.
So they're going to save, is China coming back to save Australia like they did back in 08, 09?
Well, it's interesting. So they've reopened. I mean, so they had the zero COVID lockdowns, the very harsh lockdowns last year. And then on a dime, they turned around and reopened everything incredibly quickly, faster than anyone expected. And as a result, retail spending has bounced back. Activity is picking up again, as you would expect after you've locked down an economy. But there's no sign of a massive fiscal stimulus program of the sort that we saw during COVID and we saw during the GFC a decade ago. Because they're nursing a property bubble. They've still got an overhang of, high-rise apartment blocks that have been built, a whole bunch of speculative forces. And they're wary about pump priming that sector again. So they're basically, I think, accepting a more moderate pace of growth and ideally less dependent on building more and more high-rise apartment blocks that fundamentally no one really wants or needs, but it's people are buying them from investment purposes. Yes, I don't think they are going to do what they did during COVID.
Do you think that with this whole talk of what they call onshoring, so basically bringing all their manufacturing back to sort of home countries, whether that happens or not, or maybe they move to other sort of Asian countries with lower sort of wages and stuff like that. Do you think that's kind of over time that will hurt China?
I think it is going to hurt China. I mean, China is losing its labor cost. I mean, when you think about economic development of any like low, country on low income, lesser developed country, when they first integrate into the global economy and become a player, their first advantage is being a low cost source of manufacturing, and that's certainly China's first initial advantage. It was the workshop of the world. It started to lose that like a decade or so ago. People were moving to cheaper countries, and also doing business in China has been pretty not easy. And then they started to rely on more infrastructure spending, things like building roads, bridges, rail freight, and then now high-rise apartment blocks in new cities, which arguably was a bit of a bubble. So they've found other sources of growth, but they are losing their initial cost competitiveness. And many businesses have gone to China and have been burnt. And I think it's not an easy place to make money. I think it's been the reality for many Western countries. And if anything, China has become more centralized, not less centralized over the past decade. And so when people talk about onshoring, it's not so much onshoring, it's really just diversifying exposure to China. That's the main thing happening. And so in some cases that means putting more manufacturing closer to home, in the case of the United States, for example, or it's moving more to Mexico or more to Vietnam, more to Sri Lanka, more to Indonesia, and less reducing reliance on China. But I look, and people say onshoring will be a source of inflation, going forward, because I don't think that's the case. I think competition is still going to remain as strong as ever. And for example, if they build new factories in the United States, if they're going to be very highly automated, robots will be the big winner, or robot makers, rather than blue collar workers in factories. So I guess that's my 2 cents on all of that.
The latest budget from Labor this week, any sort of?
Yeah, so I did get a bit of basically, in a way it's quite good. Basically they had a big upgrade to the budget numbers. The economy's been stronger than expected over the past year. Consumer spending has been stronger than expected, and commodity prices have been higher than expected in the wake of China's reopening. Iron ore prices are still over $100 a ton. Coal prices have been strong. Gas prices have been strong. So they've got a bounty of revenue, something of the order of $30 to $40 billion extra revenue per year over the forward estimates. Now, the good thing is that most of that was saved, not spent. So back in the days of Howard and Costello, where they did get a big budget bounty, most of that money was spent. Now, the budget wasn't in as bad a shape as it is today. They still had they were still able to report surpluses, but the money was spent rather than saved. But so, one tick is that they did not try to spend all of that money. And I think with good reason, because the economy, A, is strong. It doesn't need the stimulus, and B, we have a budget deficit position. So I think it's quite reasonable that they've done that. Where they have nonetheless spent some money. There's $12 billion in new spending in the current next financial year, and it's hard to argue in providing rent assistance, increasing new starts. It's been for worthy social causes. So certainly from a social welfare point of view, you can't argue with a lot of that spending. From a macro point of view, though, it is true that it probably on balance is stimulatory, in that the budget goes from a lot of headlines about the budget surplus. This is a budget surplus for the current financial year, which is just about to end in about 4 weeks' time. So, and that was a surplus by accident, because they just got a lot more revenue than they expected, and they can't spend $30 billion in 4 weeks. So it is a surplus, albeit by accident. But the budget then does move into deficit next year, and then even a bigger deficit the following year. So the move from a surplus to a deficit is a net stimulus. And at a time when we're trying to slow the economy, you'd argue that, maybe they could have been tighter on that front. They're not helping to slow the economy, and they're relying on the Reserve Bank to do all the work. So that's, I guess, a cross. But there's some positives, but there are some, crosses as well.
I just got
sorry, and just one other point on that. I mean, a bit of in the gut, they talk about, there's still challenges ahead, and we're going to have to, look at the tax system and whatnot. I think people say that they're going to do something later. I mean, I don't know, but this is if you're ever going to do anything on the tax front, now is the time, because in election campaigns it's very hard. So we've got a dilemma in Australia, is that political parties feel the need to get a mandate for tax change in an election. So they want to go to the electorate during an election campaign with tax changes, because otherwise they can't do anything because they don't have a mandate, quote unquote. So that's, as a result, Chalmers isn't doing anything at the moment on that front. But as we saw with Bill Shorten, I mean, trying to get tax changes agreed to in an election campaign, you very much open yourself up to fear and could cost you the election, as Bill Shorten has found out to his a great regret, I guess. Ultimately, the tax changes that they proposed went down like a lead balloon, and it cost them the election. So I can't see Chalmers coming out with a massive new fiscal chart. I could be surprised, but I think if they don't do it now, I can't see them doing it later.
Yeah, don't touch those franking credits or negative gearing. Just one more question. Someone posted a question. What are your inflation expectations?
So inflation expectations. So look, I've got them. I think they can, inflation is coming down. I don't think it's going to be sticky. I think, I basically agree with the idea that it's going to gradually ease over the next year. I think headline inflation getting back to 3.5% by June, June 24. So some people say it's too slow, because it doesn't actually get back to the target until mid-25 under the RBA's forecast. But I think as there was a media release, there was a Freedom of Information request, and it was reported in the press. The RBA did modelling about what it would take to get inflation back into the band a year or two earlier, and basically it would mean a cash rate of 4.8%, or another 1% higher than it is at the moment, and a likely 80% chance of a recession. So ultimately they decided, based on that modelling, look, let's give the economy the benefit of the doubt and take another year or so to get inflation back down. Given that inflation expectations at the moment are still in check, and if inflation expectations were rising and wages growth was clearly rising, they wouldn't be able to do that. But at the moment, that's why it's a balancing act. If anything, I think there is a risk that inflation in Australia surprises on the downside. Again, because I don't see wages breaking out in the way that some fear as the economy slows. And I think we're yet to see much of a meaningful decline in goods inflation in the way that we've seen in the US. That's coming through with a lag. So if anything, I think the RBA may well get its inflation. Inflation will come down somewhat quicker than the RBA currently think, within the next 12 months, which adds to the case that, we can avoid a hard landing. And the RBA can be cutting interest rates potentially as quickly as, Melbourne Cup Day, November, December this year.
So what would be the reason for the rate cuts? Why would they be cutting rates?
If inflation, does surprise on the downside, if inflation comes in lower than expected, and growth slows. I mean, if we get a consumer slowdown, also if the US goes into recession. I mean, if the US goes into recession, then I think the RBA would want to be supporting our economy.
And do you kind of see, like, obviously the US had a decade long of basically zero interest rates. Do you see that ever coming back? Never say never.
Yeah. What I do think is, again, with inflation going up, there's a lot of people saying, it's a return to the 1970s. We've got, inflation's going to stay higher for longer. Then they throw in the arguments about onshoring and and all this sort of stuff, and spending on green technology for the energy transition, all these things that are going to put it. I think we are going back to a period of low interest rates, low inflation. There's structural forces that are going to keep inflation low. Globalization, tech disruption, the AI, ChatGPT, we're just talking about it. That's going to, completely, another force for productivity and disinflation through that process. The question will be whether central banks. I think the central banks made a mistake prior to COVID in that the central banks had inflation a little bit lower than their targets. The Fed had inflation at the time running at about 1.7%. Their target level was 2%. And as a result, they thought, we needed to reduce interest rates to zero to really keep encouraging growth, even though the economy was fine. And I think inflation was low for structural reasons, and they didn't need to see it as being low for cyclical reasons and keep interest rates at zero. So I actually think when we get through this, when we get inflation back down again, it may end up that inflation stays low, goes back to lowish levels. But I hope that central banks will have learnt their lessons and see it as a structural thing. Inflation is low for structural reasons, not cyclical reasons, and so they keep interest rates at more reasonable levels and not push them back to zero again. So I've just lost the sound there. Oh, you're on mute there, Lee. You can...
All right, one final question. I agree with what you're saying. Hopefully that they don't go back to sort of those really low interest rates. One final question. The proposed restructure of the RBA, where they meet 8 times per year rather than, I think it's like 11 or 12. Do you think that's a better sort of outcome where they maybe take a bit more time to see the impact of their decisions, or does it really make a difference?
Look, at the end of the day, I don't think it'll make a huge difference. I mean, but I think it's probably warranted that they meet fewer times a year. In the US central bank, in the US, they meet every 6 weeks, so it's not every month. So I'm definitely, don't see a problem with that. The bigger concern out of the RBA review, and I've said this and publicly, is that I think the review was a problem in search of a solution in search of a problem. It was initially proposed because people were debating whether the inflation target should be reviewed. And the first thing that they said was, we're going to have a review, but we're not going to change the inflation target. So the one thing that we're potentially going to think about was taken off the table as a consideration. And that was back in the days where they thought the inflation target, some people wanted it higher, some people wanted it lower. The other thing that happened, of course, is that Phil Lowe made that infamous promise not to raise interest rates until 2024, back a year or so ago. Encouraged, and this was so-called forward guidance. It was a way to reduce long-term bond yields without having to buy bonds. If you promise not to raise rates in several years, the markets don't price in tightening and it keeps bond yields low. That was the whole basis for that promise. That's why he made that promise, or that conditional promise, I guess, subject to the economy. And that's blown up spectacularly in his face. And so the review has now gone into all of that. But the bottom line of the review is, my biggest concern is we're going to have like 6 new independent board members who are probably going to be academic economists who've got even less idea about the economy than the Reserve Bank. And a lot of the academic economists were all for the forward guidance, the promise that Phil Lowe made a couple of years ago, because it came out of academic literature. So I fear last thing Australia needs is 6 academic economists squawking about interest rates every week and debating in public, what should be done with interest rates. I think it'd be a disaster. So I actually hope that the government reflect on the review and don't just sort of mindlessly accept all the recommendations that come out of it. But so that's what I fear, the change in what is otherwise, a pretty good bank. And I mean, it's done a pretty good job over the years. He did make it, with hindsight, a terrible mistake in making that promise. But that was actually that came from academics. And so the solution is not to have more academics on the board. But that's everything. That's me. I'll get off the soapbox now. But
Very interesting perspective, Dave. Much appreciated. Look, I think that's it for today's webinar. Look, David, thank you very much for your time. Much appreciated you taking time out to talk with me and our clients. Thank you to Craig. I know he's on the call as well. Thank you very much for organising today's webinar. Look, again, we're recording this webinar, so we're going to send out a copy to our clients later on. Hopefully you've taken a bit of information today away, and if you've got any questions, like please feel free to send them through. And if I've got anything that I can't answer, I'm happy to pass them on to Dave. And yeah, thank you very much for attending today, and I'll catch you later.
Yeah, bye for now.
Thanks, Dave. Thanks, Craig.